Hello, everybody. Welcome to Clever Investments. So last time we talked about beating the market with value investing. And to me, this is way too hard. And I'm also not smart enough. Now, let's look at another method of beating the market, which is called arbitrage. So I will use Edward Thorpe as an example of how he beats the market using arbitrage. And Edward Thorpe is a mathematician professor in UC Irvine, and he has wrote many good books. One of his books explained how he can beat the dealer in blackjack, and he also studied other games. Later, he switched his interest to investment, and especially in option pricing. So he found at that time the pricing of options are not good enough. So he started profiting from those mispriced options. And he has a book called A Man for All Market. And this is a great book. I highly recommend everybody to read, even if you are not invested in arbitrage. Anyway, when he was doing arbitrage in options, he defined a mathematical model, and he found that existing options price is different from what he calculated from his model. So if the option price is too high, he would short the option. And if the option price is too low, he would long the option. And after he did this many, many times, when the option price goes toward his theoretical value, which is a better model for the option value, he make a profit. And this profit is very consistent. It is also market neutral, which means no matter the market goes up or down, he continues to make money. So this is a great way to make money with low risk. But the problem is, as more and more people find out that there's a pricing, there is an incorrect pricing in the option, they would also do the similar thing. So the arbitrage opportunity would disappear. And Thorpe has to find new ways to arbitrage, and he always can do that. So he made lots of money. A few weeks ago, I mentioned that I also did a hedge fund with a friend, and we were making money with arbitrage. So basically, we also found a small arbitrage opportunity in the market, and we invested our own money. Actually, in the several years we were doing it, our investment goes up consistently, regardless the market goes up and down, and it goes up a lot, beats the market handsomely. But later, before we try to look for the first client, that opportunity basically disappeared. So I couldn't find a new opportunity, so I shut down that hedge fund. And I feel this is way too hard. You not only need to do hard work, but also you need to be smart enough to keep finding new opportunities. And I feel this is even harder than value investing because it's pure math. So you need to figure out the incorrect price that everybody else couldn't figure out. So this is not for me. I don't want to try to beat the market with arbitrage. So in summary, practically how hard it is to beat the market. And my conclusion is it's not very likely, because after all, this is a zero-sum game. So if you want to make more than what the market can provide, somebody else will have to lose that money. And zero-sum game is a dangerous game because you have to be better than almost anybody else in order to make good money. And I said it's almost a zero-sum game because good investors, they are able to make the market bigger because, for example, they find a good company that nobody found. They invest into that company and make that company turn around, become a very good company. So that actually increase the total size of the market. So it's a positive sum. But for us, average investors, there's no hope for us to do that kind of influence. So basically, it's a zero-sum game for us. And also, in order to play this game, we have to compete with professionals in the world. And today, most of the investors in the whole market are professionals. And what are professionals doing these days? So if you look at history, you can find that they're not doing very well. So if you search how many fund managers or professionals can beat the market, you find many different numbers. Some said 80%, some said 90%, some said 97%. So, but all conclusions saying that most of the professionals, they cannot even beat the stock market. And can we do better than them? Not very likely. Also, those professionals, they do this as their full-time job and they get paid very well. But for us, I still want to follow the Clef principle, which means I want to be lazy. I don't want to spend too much time on this. So any time-consuming method is not for me. And also, there's a very high friction if you try to beat the market, if you want to do trading frequently. Tax is a big thing. So if you, in 1 year, you make more than the market, you have to pay up to almost 40% of your capital gain to the government if you live in California. This means you have to make almost 15% every year, so that after tax, you still have 9% left, which is the stock market average return if you reinvest the dividend. So this is a very big friction. And I'm not even counting other regular transaction costs, such as a commission or the slippage, which is also called the bid-ask spread. And you may wonder that, well, what if I do tax loss harvesting, which can reduce my capital gain and reduce the tax I paid? So yeah, you can do that, but you can only do that if some of your investments are losing money. So that can happen in bear market. But if you are doing well, you are making money, then the chance of doing tax loss harvesting is not very high. So overall, I don't believe I can beat the stock market and still have time to do my regular job well. So for me, I will only expect to get the same market return as the market index. And by doing that, I actually can beat most of the fund managers, most of the professionals, which for me, I think that's good enough. Okay, so that's all for today. Next time, let's talk about the concrete ways to invest in stock market. Okay, see you next time.